Welcome to Traders Corner, our first show of 2016, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome back after a rather long hiatus. Nice to be back.
Thanks very much, Juliet. It is nice to be back.
So it's a new year, and I keep saying Happy New Year to everyone, and the answers that come back are a trifle jaded, I have to say, because it's been a very, very tough start, especially for those trading the markets. And the sense that you get from 2016 is that it's probably going to be a lot tougher than any of the years that we've seen previously.
I certainly think so. You know, Traders Corner has been going for 6.5 years now. We started in the middle of 2009, which was more or less around about the start of this bull market that we've seen over the last 6.5, 7 years. And it now looks increasingly like this bull market is coming to an end, or it probably has come to an end. In fact, we'll show a whole lot of charts of the international markets just now. But a lot of these markets peaked in April last year, and they've been gradually grinding lower ever since. So technically, it doesn't look great. And I think that 2016 is probably likely to be my most challenging year since starting this show 6.5 years ago.
Yeah. I mean, you've always described yourself as a natural bull, so that is going to be a challenge to one who's optimistic at heart. Garth, as we do every year, we lay out the goals and maybe just give some people who are new to the show what the show is about, what we set out to achieve. So you've got that slide up there, so talk us through it.
Yeah, that's it. So how this show works, it's every week on a Tuesday we record the show. I put 250,000 Rand up of my own money, which we then utilize to trade the market using the various different techniques and technical analysis principles that I talk about on my courses and on my website on traderscorner.co.za, all that sort of thing, and package it all into a trading show, showing people how we trade the market. So it's not always glamorous. I think trading often has this sort of glamorous element to it. You tell people you're a trader and they get all sorts of glamorous ideas. It's not that glamorous. It really isn't.
I mean, it's sitting at home in your underpants trading the market, isn't it, at 2 o'clock in the morning?
Sometimes it's that. But you know, we try to portray trading in a realistic light, and our motto for the show is promoting proper trading principles. So we're looking at all the correct ways to trade. How do you do it successfully and sustainably? We record one show per week. We look to try and identify opportunities that we can trade on the local market as well as the offshore markets this year. And that's a new element that we're going to be bringing in is the offshore markets. We're very, very strict with risk management. We never risk more than 2% of our total trading capital at any one time. So what that means is that with that 250,000 Rand that I have at my disposal to trade with, I never want to lose more than 2% of that money, i.e. I never want to lose more than 5,000 Rand on a single trade. And that's the risk management philosophy that we stick to on this show, and it's worked very, very well for us over the last 6.5 years, keeping the losses small. And then at the end of the day, end of the year, all profits that we make on the show are donated to charity. And the last 6.5 years have been very good. We've had some very nice, handsome donations that we've handed over to the charities that we support. And obviously, I'll be doing my best again in 2016 to try and build up some profits to hand over to charity again.
Yeah, but as you say, it may be a lot tougher this year to do that. Okay, so what are your goals for the year then? Because normally, and I think this is something that you advise most traders, to set themselves goals that they would like to achieve.
Yes, I think it's always a good idea at the beginning of the year to set out some goals for yourself. And a lot of people will say, oh, well, my goal is to try and make 40% on the market this year. Well, awesome. But, you know, how are you going to do that? Rather set goals that you can actually obtain and you can be in control of. So the 3 goals that I always set at the beginning of the year are actually the same ones, and the reason I keep picking the same goals is just because they work. So I want to try and achieve 65% win rate on all my trades. That means that basically 2 out of 3 trades need to be winners. I accept that 1 out of 3 is probably going to be a loser. That happens in trading. You're not going to win on every single trade. I want my risk to reward ratio on my winning trades to be 1 to 3. So for every 1 unit of risk that I assume, I want to ideally be making 3 units of reward on the winning trades. And of course on the losing trades, well, you only want to lose the 1 unit of risk. And then the last goal of the 3 is just to be patient and wait for the right opportunities to act on. It's always, the market has a magnetism to it. It always tries to suck you in and make you feel like you should be involved and you should be doing something. In line with promoting proper trading principles, as we talk about on this show, we want to be patient and we want to wait for the right opportunities to act on. not just trade for the sake of trading.
Because it is, as you say, it's this allure, or it kind of pulls you in because you think, oh, I've got to do something. People are making money, and I can see opportunities, and then you can lose your head quite easily if you're not patient.
That's right. So patience is very important. And by and large, we've managed to do well in that space over the last couple of years, and I'm certainly hoping to try and do well there again this year.
Okay, so those are the goals, and as you say, they're pretty much the same goals that you've had for the last 6 years. This is now when everyone actually needs to pour themselves a very stiff drink because you're going to go through a whole series of charts showing us the state of world markets. And I had a look at them before we went on air, and they look rather scary, I have to say.
They do. So we're basically going to go for a quick tour around the world, looking at some of the world's biggest stock market indices to see how they shape up and what the technical patterns are looking like as we go into 2016. And at the end of it, to try and say to ourselves, well, are we in a bull market or are we in a bear market? So we're going to start in the West, and we're going to start with the US market, and we're going to start with the S&P 500. That's the biggest stock market index in the world. It's the most widely followed equity index throughout the globe. So there you can see, now this chart goes back to 2009. It is a weekly chart. All these are going to be weekly charts where we plot one candlestick pattern per week over the last 6 or 7 years. What's quite evident here is that we've got this uptrend that began in 2009, and it fitted quite nicely with the bull market over the last 6 years. Notice, however, that we've begun to break to the downside. We've broken below this long-term upward trend, and it looks increasingly like we're making a head and shoulders pattern over here. And also interesting to note here is that this comes at a time when the Fed in the US has stopped quantitative easing, and they've stopped their accommodative monetary policies, and they have started to hike interest rates. So it's quite interesting to see how the market is gradually rolling over with these fundamental backdrops. Now, if that head and shoulders pattern is validated, and what I mean by validated, basically it needs to break below the neckline of that pattern. A break below 1880 on the S&P 500 would be a break below the neckline of that head and shoulders pattern. And that would then project down to a target of around about 1600 on the S&P. That would mean that from the top to that potential downside target would be a 25% pullback for the S&P 500. Now, it might sound a lot, but if you go back in history and you look at prior bear markets, that's very, very possible that we see that sort of pullback. In fact, that wouldn't even be a big bear market in the context of some of the bear markets we've seen previously. So very, very important to watch that 1880 level. And that, to me, does look like that whole market is topping out.
Garth, you also mentioned in ahead of the show when we were speaking that the sub-indices of the S&P 500 are looking horrible. And you talk about market breadth. Perhaps you could just explain that, because like our own market, there's one or two shares keeping the markets propped up. But if you actually look underneath, the picture, it maybe gives a clearer picture as to what's going on.
Well, that's right. We look at market breadth to try and determine the health of a bull market. And in a really healthy bull market, you want a vast majority of the shares on that market to be participating in the rally, making new highs and so on. Now, what we've noticed increasingly over the last year or so is that on all of these markets, the S&P 500, but also all the other international markets that I'm going to show you, the market breadth has been deteriorating, meaning that you've got a couple of very large cap shares at the top which are doing fairly well and propping the overall index up because of their heavy weighting in the indices. But below the surface, you've got a lot of shares that are looking weak and possibly even making new 52-week lows. And when you've got a situation where the breadth is deteriorating like that, what it means is that the market leadership is very concentrated with a couple of shares. And if those shares start to gradually begin to roll over, then you actually sit with a big problem on your hands. It's very evident in the South African market. I mean, we've really got two shares, Naspers and SAB Miller, that are heavyweight shares holding our market up. For the rest, it's a bear market.
Okay, well, we'll get to the top 40 in a moment, but just going through the world, what about the FTSE and some of the other indices?
Let's move further east now. We're looking at the FTSE 100. Now, this is the London Stock Exchange, the top 100 shares on the London Stock Exchange. Again, notice this uptrend that's been intact since 2009 has been broken to the downside. We've had a market move sharply lower in August last year. It's rallied back up and it's tested the underside of that prior uptrend, but it appears to be rolling over again now. So this, to me, looks vulnerable to further weakness down the line, I think.
And what about the DAX? Because the DAX, in fact, at one point last year was the best performer. It had a cracker start, and then things started going a bit pear-shaped.
Yeah, it did. And also it had a good move when the ECB began to announce some stimulative measures for the markets there. The DAX, out of all of these indices, is probably the one that still looks the best, I think. There's your uptrend going to 2009. I've cut out that sort of flash crash type of thing in 2011, but that trend line fits quite nicely with all the lows since 2009. But what's critical here is that the DAX needs to hold above 10,000. It's been testing that level this week. We have traded marginally below it, but we're back above it now. If the DAX starts to crack underneath 10,000, then I think you would say that this bull market is over for the German market. So that's going to be very, very interesting to watch this year.
What about the Asian markets? Because I mean, a lot of the weakness stems from the Chinese market. But what about the Nikkei and the Hang Seng, which of course is the offshore Chinese market?
Yeah, we're going to look at the Nikkei and the Hang Seng in terms of the Asian markets. I'm not going to look at the Chinese market, mainly because it's not a big stock market in terms of global markets. It's very much concentrated with domestic players in China. So we want to rather look at the Japanese market and the Hang Seng. So here you've got the Nikkei, which is the Nikkei 225. It's the biggest index in Japan. What's interesting here is that this market really got going from late 2012. And this is from when Shinzo Abe introduced his Abenomics economic policies, which have been very stimulatory. And since then, we've seen the Japanese stock market moving sharply higher. But also note here that this uptrend that's been intact for the last 2.5 years has also broken to the downside, and we've had a rally to move up and retest the underneath of that prior uptrend. What also looks very evident to me here is that we've got a head and shoulders pattern forming on the Nikkei. Now, if the market here were to break below 17,000 on the Nikkei, that would then project a downside target of 13,000 for the Nikkei. So that would be quite a significant pullback for the Japanese market if we got that pullback.
And quickly, the Hang Seng and then also the Australian index.
So the Hang Seng also not looking great. Hang Seng has a lot of Chinese shares listed on its market as well. And there you can see in August of last year, when the Chinese market effectively crashed, the Hang Seng broke through that uptrend support. It's rallied up, failed at the underneath of that prior uptrend, and it looks to be turning lower. So that also, to me, looks like quite a bearish setup over there.
And the Australian market?
Australian,
that's kind of an outlier, but
yeah, but nevertheless, it's still a big market. And the Australian market, like many of these others, it's broken its bull trend from 2009. You can see that nice fitting bull trend over there. But what's happened over the last year or so, it's broken through the bottom of that uptrend, and it's been consolidating here. This, to me, looks like it's vulnerable to another leg to the downside here. So, 2016 bull or bear, so far all these international markets, to me, are looking rather bearish.
Okay, and what about the JSE? Because you mentioned the two shares that are propping us up, SAB Miller and Naspers. Yeah,
so we bring it home in the SA Top 40 Index. Here you have it, back to 2009. Again, you can see a nice tight-fitting upward trend over there, but that uptrend has started to give way now. We've broken to the downside. We've rallied up, retested the underneath of that uptrend. What's very interesting here is this 41,000 lateral support level on the top 40 index. We need to watch that level carefully. If our market should start to break below that 41,000 level, then technically that points to a downside target of 33,000.
Ouch.
So we need to be very, very aware of that this year. And yes, our market really has very, very poor breadth. We're being held up by SAB Miller and Naspers mainly. Maybe there are a few other shares that are performing well, but scratch below the surface, and we're in a bear market in South Africa.
Garth, I think next week, perhaps we can maybe discuss in more detail how you trade a bear market and how you have to adjust your trading, especially if you've been a bullish trader for the last 7 years or 6 years, which is what you have been. Yeah. We don't have time for that, but just to wrap up with a reminder of how much we've got in the kitty and also your next courses.
Well, there's our portfolio. We've got 250,000 Rand in cash. That's the starting value. Obviously, no trades this week. And then last thing, courses. I am running my high probability trading course in Joburg on the 30th of January and in Cape Town on the 6th of February. So anybody interested in attending either of those courses, please email me on garth@traderscorner.co.za for all the details.
Okay, great. Garth, we'll leave it there and we'll pick up with you again next week. Tuesday, that is Garth McKenzie, founder and editor of Traders Corner.